Good afternoon, ladies and gentlemen. Welcome to Business Today and our special edition of Market Masters. My name is Shail Bhatnagar, and with me is my colleague Sakshi Batra. It's a fantastic day today. Post the successful completion of G20 summit in New Delhi, we've had a wave of fresh buying coming into Indian equities, and it's only a matter of time that you'll see Nifty joining a batch of indices which are already at record highs. Our guest today is a special gentleman, Mr. Atul Suri. He's the CEO of Marathon Trends, a 5-year-old portfolio management services scheme, and Mr. Suri has a checkered past. Apart from being the most nattily dressed gentleman on the Lal Street, Mr. Suri has a special talent, and that is overlaying technicals over fundamentally strong stocks. Marathon Trends at the moment manages about 300 crore rupees over two portfolios. One is Mega Trend and the other is Trend Following portfolio. Both of them have 20 stocks each, and they have a sensible dispersion over large cap and mid cap counters. Mr. Suri, apart from being the CEO of Marathon Trends, has earlier worked for about 15 years with one of the most well-known names in the Indian equity space, that is Mr. Rakesh Jhunjhunwala. And before that, he's sharpened his stock picking skills at Aditya Birla Mutual Fund and of course Parag Parikh Equity Services. Mr. Suri, it's such a pleasure to welcome you today on a fantastic day when the sentiment is so good on the Lal Street, and you haven't disappointed us in wearing such a fine tie and a beautiful shirt. Welcome to Market Masters.
Thanks a lot for very kind words, I think.
Okay. Now comes the difficult part, Atul, and for all fund managers such as yours, especially in this intensely competitive portfolio management scheme game, is a difficult time. Record highs, successive record highs on mid caps and small caps, extremely high valuations, and of course Nifty headed the same way. How difficult is it to pick stock winners now?
Yeah, essentially what happens is that when the market has taken off, which it has, at this point in time, the big question you ask yourself is in terms of risk reward. When the market sort of started, the rally started emerging way back in March, April of this year. It was quite nice when the Nifty was at much lower levels, maybe about a good 15-17% lower. You always felt that you never know when the bottom is, but you knew that the risk reward was in your favor. Today, the
Yes.
thing is that the market has run up, it's near 20. I'm not saying that it is too expensive, too frothy, this is the top, not at all. I think there's a lot more to go. But yeah, the risk reward actually gets a little more dicier. And as before you buy, you just don't go out and buy. You look at, hey, how much has this stock run up? How much can it give back? What if things go wrong? So the risk reward is not as it was maybe a few months ago. I think it is more at par than maybe a 1:3 kind of ratio that you had a few months ago. So definitely that is a different mindset that will require a different allocation to the portfolio. So that is the challenge. But still, I continue to think that the markets are headed higher. The small and mid cap rally is not over. So if you ask me that would I take a cash call, the answer is no. The only thing that I need to manage is my risk, and that is by proper a favorable risk reward ratio as far as markets.
Fantastic, Atul. Let me address the bull in the China shop immediately. You say that we have a fair roadmap and a nice runway as far as Nifty is concerned. Let's presume it's March of 2024, and the rally that we've seen so far has stronger legs. What, according to you, would be an optimistic estimate on the Nifty?
Yeah, so like I have been actually on media and been talking about a target of around 21,500 to 22,000 on the Nifty, which even from these levels is around a good, I would say 10% plus from here, which I think is very good because if you look at it from an index point of view, from after the move that we've had from around 17,000 that was there sometime in March to where it is right now. I feel that even if we have another 10% upside on the index per se, that's great, because also what we are realizing is that in this rally, the Nifty's performance is muted by virtue of the composition. Let me explain this. That if you look at the two principal contributors to the Nifty, one is banks and second is IT. And if you look at the large cap banks and the large cap IT, you'll realize that these two are actually not doing much. In fact, they're almost sideways. And though the market is not at lifetime highs, the lifetime highs being just about as recent as 20,000 or whatever, but a lot of sectors and stocks are at lifetime highs. So for me personally, the broader market is at lifetime highs. The Nifty is not there. The Nifty's performance is muted because your two principal drivers have actually been sideways. So if I say a 10% up move in the index from here, I feel overall there'll be a lot more gains in the portfolio. I think there'll be a lot more opportunities. And the most impressive part of this rally is that it's very broad based. One is, of course, headline numbers, indexes that we look at, but breadth is very important. So you are seeing excellent sectorial breadths. You see the number of sectors that are making new highs, and excellent stock breadth also. See the last month of August, if you see, the index was, I think, just 0.5% negative or something. It was a consolidation or a time-wise correction. But you'll find that stocks continue to make lifetime highs. Sectors continue to make lifetime highs. So I think for me, the breadth is actually more encouraging than just the Nifty. That's why I feel that a 10% up move in Nifty will be very, very good for investors, because I think a lot of stocks and sectors will outperform by miles.
Okay. Mr. Suri, good afternoon to you. I wanted to actually ask your views. Over the last 48 hours, you would have witnessed the way the world has been watching India amid the G20 summit. I think Vasudhaiva Kutumbakam, history in the making, India's presidency, 100% consensus on the declaration, the way India has emerged as the voice of the global south. How
Right.
has all of this really reflected on the Indian markets? Do you see a meaningful reflection of that in the coming months or so because of the G22?
See, I think that it is definitely a sentiment booster. It's very important. And India as a country, as a race, the whole shift from India to Bharat, I think is very, very symbolic. And it's a mindset shift. The big difference that I'm noticing is the mindset shift. All of the physical assets are nothing but follow or what humans do. And if humans and a race, we start thinking differently, we start thinking with confidence, I think that's the biggest shift. As I said, it's not the tangibles, the intangibles that create revolutions. It's the ideas and beliefs that do. And I think we are transitioning to that. As far as the impact on the market goes, yes, it definitely has a positive sentiment and a rub off effect. But specifically, some sectors or some themes get affected more. And since I'm a trend investor, for me, that is very, very important. What I think, Sakshi, is that what has really shifted, or what I'm noticing in the last up move for the last few months is that for many years, Indian markets were dominated by a few stocks which were external driven, which were export driven. So I mentioned IT, large caps, and a lot of other sectors, which were more about exports and opportunities globally. But what has changed in the last 3 to 6 months is that the sectors that are leading are actually internal driven. And the bet now is about growth in the Indian economy per se. For example, the most spectacular sector move in the last 1 to 2 months has been the PSUs, right? Whether it is defense stocks or whether it's your rail stocks, etc. It's been spectacular. This is like the most dog sector. Nobody made money. Most of these stocks for almost a decade. And what is changing is the decadal shift that is happening. So the trends that are emerging also are changing. But it's not just the few large IT stocks. They will do well. They will do well in the future. They've been the biggest wealth creators. But the shift that is happening is more inward looking, more India story, more manufacturing related, and more sectors, themes, and stocks which have been ignored for a decade. And that is why when something gets ignored for a decade and does a big basing formation, those rallies don't end in a few months or weeks. These rallies continue to be larger. And that reflects with your question of the theme, that what is shifting. I think there's a massive shift that is happening in the markets, and we can see that in the sectors and themes playing out. There are sectors and themes which never did well for 10, 20 years. If you ask most market veterans, the moment you said PSUs, they would say, no way, man. Like, lot of false starts. So many, everyone has bought, sold, burned themselves, and like just doesn't want to get into PSUs. But
Yeah.
you'll see from last year it was PSU banks, this year it's some different set of stocks. But they have been the biggest wealth creator. And that is a reflection of the shift that is happening in the Indian mindset, mentality, and all. Maybe
Right.
that's where the opportunities are.
Let's take this discussion a little forward on the PSU basket. And Atul, you very rightly put it. Nobody made money in any PSU stock if he held it in his portfolio for the long time. In fact, one of the biggest wealth creators, I'm so sorry, wealth destroyers
Choice.
till about, say, 2022 have
Right.
been these PSU shares. And yes, this is a long term chart which is opening up on the horizon. Atul, you do a lot of work on global markets in terms of tracking bond yields, tracking interest rates, tracking the inverted bond yield that is seen in America at the moment. Of course,
Right.
India is an island of safety when it comes to the kind of money that we are making on Indian markets. Is there a cause of worry globally? Do you see some charts contracting or giving signals where there might be some pain in the offing?
Yeah, I mean, absolutely. This is a very pertinent question. Like there's, as you said, we've been watching G20 and we are seeing our markets, so we kind of forget the world. But I'm a firm believer that there is a certain sink in global markets and global
Yes.
flows. You cannot, the whole world cannot be correcting and you're the only guy going up. So sooner or later you will catch up. And I've seen that in 2008 when that whole decoupling theory was there. Everything may not be timed to perfection, but more or less there is a theme, there is a trend to it. So I'm very, very careful on not ignoring global markets. Yes, when some countries do well, they may relatively outperform, but you cannot beat the overall global trend and liquidity flows. So here, if you ask me, the thing that I look at every morning is the first thing that I look at is the US 10-year bond yields. Because whether you like it or not, the big flows actually are very determined on what interest rates are. And you know that when interest rates are going up, it's kind of negative for equities. For us, India in 2022, I think we were kind of spared. But if you look at some of the global markets, especially the US, etc., you'll find that 2022 was a very difficult year. And this was a year where bond yields, which were almost 50 bips, went up to 4.25.
Take two.
That was the US 10-year, and that had a negative impact when US bond yields kind of peaked out, I think in October of 22 or thereabouts. That's when you realize that US markets also started bottoming out and the rally that they made. The interesting part is that as we look at markets right now, bond yields are back to where they were in October of 22, which is around 4.25, 4.30. And that for me is worrisome. If you ask me, there's only one big red flag I see, and that is something that the world had come to believe that inflation has topped out. It is history. The Fed is not going to increase. In fact, the whole cutting cycle may happen. But the mindset is changing and they feel that inflation is yet not fully, the genie is not in the bottle. And there is a risk of the Fed hiking more. And that for me could be a very big negative for equities. Of course, global equities, but they will have their knockdown effect in India also. We saw that last year. We saw the kind of FI selling that we experienced last year was massive. So for, as I said, that in the global universe or in the global charts, if there's one thing that stands out is what the US bond yields are doing right now. Anything above 4.25, 4.30, the risk is that they can nudge higher, almost I think they can go to up to 5% or so, which I think will not be good for global equities. And that could be a dampener to the current, mood that we have in India. So for me, that's the big red flag right now, globally.
Okay. Mr. Suri, we have one question related to the global markets from our viewer, and I'd like to put that across to you. From Mumbai, Shashank Sheth has asked you this question. Is it a good idea to consider foreign stock markets for portfolio diversification? And should one also look beyond US markets?
Uh, Again, I may be biased in what I'm saying because I belong to Indian markets, but many years ago when I was studying abroad, I made a decision to come back to India, and I really don't regret it. And I think that same mindset is what really trickles down to investing and Indian markets. From time to time, global markets do well. And then, there is this whole thing about, oh, I should be in NASDAQ or I should be in Japan, I should be in China. But I feel that for an investor, the biggest opportunity is in your own country. We see a lot of global reports coming out, a lot of narratives talking about that this being India's decade or whatever, the growth in the economy. And our markets are nothing but a reflection of the economy, right? So if the big action globally, economically, and we are seeing so many, like what happened in G20 was a representation of that, is going to happen in India, I feel that Indian markets will reflect that. Markets reflect what is happening in the economy. Maybe with a lag, may not be to perfection. Just as stocks are ultimately a reflection of what the earnings are coming out. It's ultimately related to that. So if we are going to be the big story for the next decade, yes, you can do some diversification or some currency related plays, etc. But I don't think that you need to put a lot out there. As I said, global markets tend to move in sync. However, we have to look for that stock, that country, that sector which outperforms. And if India is likely to be the outperforming sector, I would say that we are at a very fortunate time in history where we are in a country at the right place at the right time. So I, for one, am not a. As I said, you may do it for purposes of little bit of play here, there, little bit of diversification. But I would have most of my wealth in Indian equities because I think that's where the opportunity is as an economy, as a country, and the markets are going to reflect that.
Okay, let's take one more question from our viewers list, and that's something that you were already pointing out, that nobody made money in for the longest time in railways, defense and PSUs. So Aditya Sharma from Noida has sent us this question on our WhatsApp number and asking, between the three or among these three, railways, defense and PSU stocks, where will one get better long-term growth now?
It's again very difficult, in the whole PSU basket to really. So in these such cases, what you really need to do is actually spread, a little bit of carpet bombing, because you realize that these tend to be thematic moves. Like if you see some of the railway stocks moving, I mean, like whether you'll pick A or B, or even in defense, you'll find that, someday A does well, someday B does well. I mean, if when you talked about railway stocks, sorry, about defense stocks, it was Hindustan Aeronautics, Bell, etc. But if you look at the performance of the shipping stocks, Mazagon Docks or Cochin Shipyard, you realize like they have like far outstripped. So very often in such a case where you really don't have much differentiation, clarity, it's more of a policy. It is yet it's not translating to that kind of numbers where you can sit and do an analysis of each of the companies. I think you're very better off taking a bit of a carpet bombing approach. You need to allocate across the board. And in this, someone has a good day, a bad day, a good month, a bad month. I think you will do well with the overall returns that is happening, So there are very differentiated kind of returns that happen in each of them. But definitely PSUs are an exciting space, a lot happening out there. And still in terms of after these moves also, you'll find the valuations are still not very high, So I would sort of recommend a bit more like a carpet bombing approach. And once the numbers start playing out over the few years, you get a better understanding of how these businesses are actually, the opportunity is there. How are each one able to translate it? Once you get the differentiation, then probably you can reallocate.
Atul, you've waded into one of the most difficult chapters as far as markets are concerned today. How to benefit from this phenomenal rally that we are seeing in railway and especially defense stocks. Now, there is this huge feeling of being left out in the market as far as defense plays are concerned, and you sort of hit it on the nub, which is the shipbuilders. You have a trend following portfolio, 20 stocks aimed at opportunistic plays in the market. Of course, quality is an underlying filter which you have. Tell me, how are you allocating money on defense plays? And since you are such a fabulous technical analyst yourself, how are you playing the shipbuilder rally and the railway PSU rally?
So, as I said, that the number of stocks are kind of pretty limited. If you see defense, also there are hardly 5, 6, 7 stocks. The big guys which institutional investor can even enter. Liquidity is a very big issue. So, first of all, the number of stocks are limited. Now, what I've been noticing is that definitely they have been an uptrend for the last, whatever, 6, 9 months or 1 year. But each of these stocks, they do have vertical moves. Like, some days they just go up vertically, like you're seeing that today in some of the railway stocks. However, this vertical move doesn't go on forever. They also go in for consolidation. And I am the kind of guy who would rather wait for a stock to, I would not chase a stock that's up 10%, 15%, 20% today. I would actually look for stocks that consolidate. And when they come out of consolidation, I feel that that's when the next leg of the up move kind of starts out. As I said, Shelley, it's very difficult, to who's going to get a defense order, where, when, why, how. Genuinely, there isn't supreme predictability. So first and foremost is I would be careful about allocating at these levels. As I said, my first answer was risk reward. When stocks have gone up that much, the risk reward is not very, very favorable. Yes, the trend is there, you will participate. So be careful about how much you allocate. And number two is that don't chase stocks that are just kind of running away. All these stocks also go through consolidation, they go through corrections. And when markets consolidate or correct, I think that's when the opportunity is there to play out. So I think it's more tactical. It's more tactical than anything else. And as I said, that for me as an individual who runs a PMS, I have to be very, very careful about how I manage risk, how I control the downside. Because when corrections come, that's when the true strength of a trend is visible. Like Warren Buffett says that it's only when the tide turns, you know who's swimming naked. So in all these stocks, in all these small cap plays, till the going is good, it's fantastic. It is only when the corrections come, that's when you really know who stands out. So I kind of like to buy these plays in kind of corrections. The correction can be price wise or time wise, that we don't know. But be careful about going all out or allocating too much. Because as I said, after such big vertical moves, the risk reward tends to be difficult. I'm not saying the story is over. I'm not saying the opportunity is not there. But in the short term, you can take a hit. Be careful about that.
Absolutely. Atul, I have been actually shouting hoarse, trying to sound cautious, but such is this trend and tenor of the bull market that caution has been thrown to winds. And both of us know that these are classical bull markets playing out in the mid cap, small cap, and select PSU spaces, more due to lack of liquidity than any fantastic growth coming in terms of earnings. I'd like to touch upon Bank Nifty, not as an index, but as a specific group of private sector banks. Since you do fundamentals so well, some of the finest moments in terms of earnings have been seen in 4 or 5 private sector banks. It's across the board. Lower NPAs, lower GNPAs, fantastic NIMs, and of course double-digit credit growth. Somehow banks are not reflecting it. Are they going through a time correction, or is the best behind them? What do the charts tell you?
No, I think that's a very pertinent question. The very fact is that you're admitting that, even I find this mismatch, that the numbers that are coming are stellar. Okay, they are stellar, they're dream. We haven't seen those kind of numbers come out in decades. But you're not seeing that in translated to price movements. So the market definitely knows something or is telling you something. And for us, I mean, shockingly, we are underweight some of the banks. Being overweight banks is a consensus trade, I tell you. Everyone is overweight banks. The biggest beneficiary of the change in capex cycle, etc., is banks. But we kind of prefer financials. So we feel that the NBFCs, as we see them, even they are reporting fantastic numbers. But the kind of response that they're getting from the market is very differentiated. So we as trend investors appreciate that not only is it important to make a beautiful boat, but you also have to be able to navigate it through currents. And if I look at the tides, the currents, and the winds, the market is telling me that, as you rightly put it, that, well, the numbers are there, the fundamentals are phenomenal, but it is not, the winds are not with them. I feel the wind and tide is more with the NBFC space. So we are actually underweight banks and we are overweight NBFCs. Again, they are in a similar sector or theme, if you may like to say it. But clearly, one has to be aligned with the trend. And that's how we are really seeing this or playing this area. But it is definitely an area which is of concern because most people are overweight banks and financials, and they are actually frustrating to be in your largest overweight position and not see much price action. You find that the rest of the market is moving ahead or is beating you. And ultimately, we are all in this game of relative performance. We all want to, you know, beat the index, beat the competitor, beat whatever. And this has been a bit of a lag. It is true.
That's right. Mrs. Suri, if I ask you and tell me if I'm right when I say that in the Indian equity market scenario, 90% of the participants have a less than 1 year point of view when they invest in the markets. Only about 10% have a 3 year or a 5 year view. I want to ask you from you, because you have these two schemes that have that cover both of these aspects as well. What is looking good to you from a very short term 1 to 3 year perspective? What is looking good to you when we talk about 5 years and more perspective?
See, you're right that over my life in the market, I have seen this long-term investing's time horizon crunch. Verbally, people may say I'm a long-term investor, 5 years, 10 years, but honestly, hand on heart, when you underperform for 3 months, 6 months, people start getting. So that's a lot of good. It's good to write books and it's good to talk about them on blogs. But really, I found a big mismatch, or if I would say a bit of hypocrisy in that sense, the term. So in reality, I find that whether you like it or not, everything in life around us, the speed is changing. Things have become faster, and if it is happening all around us, whether it's fashion, whether it is the movie business, whether what you eat, the places you go to on holidays, whatever, right? The things that we consume, the cycles have become shorter, they've become faster. And why not then the market? So I, for one, think that the definition of long term, medium term, and short term has actually got compressed. And that is also showing in the market. Trends and themes used to last for 3 years, 5 years. Like that's when we launched mega trends. One of the reason when we launched 2017, 18 was because at that stage trends were. At that stage, you have your HDFCs and Kotaks, which were rewarding you, your Asian Paints and your Page Industries. They were rewarding you on 3 to 5 year kind of time
Absolutely.
frames, and they just compounded beautifully over that time frame. But I think post 2020, I'm realizing that the length of trends, and I'm talking about even the investor psyche, has actually shortened. Like in 2020, when COVID hit, the sector to bet on was pharma. And
Yeah.
once the vaccine was found, farmers just collapsed, didn't do anything for 2 years. Then it was maybe your metals did well initially. Then metals corrected 40-50%. Then tech did well. Your digital plays did well. Digital plays corrected 60, 70, 80%. So, I find that trends have become faster, they have become shorter, and so also is the investor time horizon. So, coming back to specifics, the fact is that the trend today is into sectors or themes which are domestic focused, inward looking, and that is why you are seeing this kind of move in PSUs. But I still think I like sectors. We do some thematic work. We have created our own bespoke thematic indexes. I like something called electrical equipments. These are stuff that is linked with not just electrification, but even there's a lot of work happening in railways. I think power and power generation is very interesting. I spoke of NBFCs versus banks. We think that these kind of plays, defense, of course, we have spoken about extensively. So I think that these sectors and themes are kind of playing out. But I, for one, think that if I had a little longer time horizon, I had to look beyond that 1 to 2 years. I find that everything to do with this is a lot of awareness, especially when you travel abroad, to do with your environment. And I find that I like in the auto space those things that have electrical mobility as a theme, especially the ancillary space. I think as far as power generation goes, whatever has to do with green, because I find that that theme is going to transcend these 1 year, 2 year cycles. I feel that the big concern for humanity and most of the awareness in the West is very high on environment. It is becoming a reality with cycles that we are explaining, monsoon, heat, etc., etc. And I think that this is going to be central. So everyone's going to look through Just as tech has been a prism for us to look through for the last 10 years, everything is technology driven, whether it's banking, whatever. I think going ahead, there has to be an environmental consciousness towards businesses. And I have a feeling that I would like to bet on a longer term businesses that have strong bias to making the world more greener and a more carbon friendly way.
Atul, the shortening of these trends is because we've replaced price earnings to growth, ROCE, ROA, ROE with alpha, theta decay, delta over the longer term, and that's the reason why our time horizons have shortened. But I am sure Mr. Buffett, whom you admire so much, will always have the last laugh when he talks about 5-year and 7-year rolling returns. Be that as it may, markets in the shorter term can be irrational, and perhaps that's what we are seeing on mid caps and small caps. But coming to a specific point that you mentioned, the digital universe in India has expanded dramatically over the last year or so. 10 billion transactions a month on UPI, and the charts are firing on Paytm, PB Fintech, you name it. Those stocks are back on your charts, and probably some of them are in your trend following portfolio. When you look at the longer term here, and the longer term I mean 3 years, especially on the digital play that is unfolding in India, do you see some winners?
So when when I kind of missed the rally that was there earlier, because one of my first filters, or as I said, my background as a fundamental analyst, is that I would never compromise on stocks which don't have
Yes.
earnings. I mean, ultimately, earnings drive. And if you go back and look at even the biggest tech names globally, whether it's Apple, Amazon, or Tesla, all of these stocks have been dud stocks at some stage. They have been actually losers at some stage for investors. It's only that when these companies started posting consistent profits that you were able to really make money as an investor. I mean, even the great Warren Buffett invested in a sector he claimed he knew nothing about, technology, his biggest investment, biggest
Yes.
success in his life. And that was well past the IPO, or away from the bottom. So I am a strong believer that ultimately it is earnings that drive prices. And I'm very happy or patient to actually maybe miss out some of the bits when there is no profitability earnings to back the kind of prices that there are. But what we are seeing in a lot of these digital plays is that at last some green shoots are, sort of visible, some green shoots on profitability. The key thing is going to be that, hey, what, are they able to sustain it? If they are able to sustain it and kind of expand on it, I think that these can be very blue sky territories. So I'm really happier to participate in the second coming, because today when I run my filters through, I do see earnings. So they qualify on my fundamental parameters, and then the price trends that there are. So I feel that the money to be made is right now. And even when you consume these services on a very practical basis, like let's say Zomato or a Swiggy, we are all used to it. We like almost use it every day. You'll suddenly realize that there's this 2 rupee user fee and some convenience charge and platform fee coming in. It had to come in, right? They couldn't just serve you and make losses. So you can see that kind of change where all opposition or competition is actually wiped out. These are your only options. And now that 2 rupee, 3 rupee is actually not an option for you. You just are going to order it.
Yes.
You are just going to order it. And that mindset shift towards profitability from just volume is, I think, going to be the trigger. That is why I look at them with more interest today than I looked at them maybe 2 years or 1 year ago. Because at that stage, it was just the story. Profitability was missing. And as profitability comes, these can be absolute rockets. Yeah.
Okay, understood. Let's take few questions from our viewers list again. Ria has asked you a question from New Delhi. She wants to ask you, what is your view on the IT stocks right now?
So IT, we again tend to be underweight large cap IT, but we do have certain mid cap IT stocks. And even in the mid cap IT stocks, we find that these are those themes that are playing towards where again I mentioned that whole issue about environment, where we talk about companies that are into auto ancillaries, but they're into the electric space. So we find ourselves, or these kind of, who have products which are more to autonomous mobility, play out such games that there are. So we do have a weightage in IT, but our weightage is more into mid caps and more into just few of these stocks. Again, it's no rocket science. Of course, I can't discuss stocks due to compliance issues, but it's no rocket science that you can look up the whole IT universe and find which are these plays that are happening out. The only problem is that they run up a lot or they may seem expensive. But as I said, that when the trends play out, they actually surprise you on the upside. So I feel that mid cap IT, some spaces are actually on a big bull market. That space on IT is actually at a very different league altogether. So I am playing those. Being a trend follower, I tend to look for those outliers because over the years I've realized that the big money is always made in the outliers. Most stocks, 80-90% will just be where they are. You make some, you lose some, but what you take home are going to be those few outliers, and I find that these outliers are playing out in the mid cap IT space.
Okay. The other question that we've got is again from Mumbai. Inderpreet Singh wants to ask you how to spot multi-baggers in a runaway market like this.
I think if you, buddy, if somebody answers that question and lets you know, please call me. Yeah. Investing is a process. If I knew that, oh, this is a multi-bagger, I would have like gone all in. But let me tell you, even the best of investors, whether it's the book buffets or the Junjunwalas, you will realize that they've also had failures. When they bet, they thought it was a multi-bagger. But I feel it's a process. It's a process. When companies continue to deliver earnings, when they continue to deliver profitability and growth, these things actually become stories. And of course, then we can go back and talk and say, oh, this was a no-brainer. I picked it up. But I have realized that the biggest way to explain the stock market is done by somebody called Charles Darwin, which is it's all about survival of the fittest,
Absolutely.
right? Just as species, ultimately, it is the strongest species that survived. Thousands of species got eliminated by the laws of nature. Nobody talks about them, nobody remembers them. Ultimately, we just talk about the species that survive. So also in our stock market, there may be 50, 100 multi-baggers and we will talk and write stories and write books about them. But let me tell you, what is going to be the multi-bagger 10, 20, 30 years from now, nobody knows because multi-baggers are a process. Let me give you a data point to tell you this. So I came in the market in 91, 92, and we were doing some work as to what is the index, the BSE Sensex, where there was no Nifty at that stage. As you know that the BSE Sensex has 30 stocks. So from 1992 till today, only 5 stocks are still there in the Sensex. 25 stocks have been eliminated. And you will be surprised that more than 50% of the stocks, I think it is almost 60, 70 of the stocks have actually underperformed the index. So when you go out and pick the 30 best stocks, right, in 1992, you'll realize that only 5 survived, are still in the Nifty. All others are kind of only 8 stocks outperform the index, I think. That's the kind of number that came. And the most interesting part, the two sectors that have created the maximum wealth in the last 10 to 20 years has been IT and second is private banks. And there was not even one stock in the Sensex in 1992, which was an IT sector or was a private bank because these sectors actually came up later.
Absolutely.
So as I said, that investing is a process.
Yes, and I would imagine Tata Motors would have been one of those 5 that have survived from 1991 till so far in the Sensex.
I'll tell you of two. I'll tell you of 2 stocks you would remember. That is Hindustan Motors and Premier Automobile.
Absolutely, they were A group
Just
stocks on
imagine if you were an
the Bombay
investor
Stock Exchange.
in those
Absolutely.
top 30 great auto companies, what would have happened to you?
Absolutely, sir. And it's brilliantly put. Atul, our job as journalists is to ask questions, and it is left to more sensible and more intelligent people like you to answer them. So therefore, multi-baggers, are found more on YouTube these days than in your portfolios. But very well said. Once we have a good answer on this one, we'll certainly come back to you because Market Masters is a continuing series, and I'm sure at some end of the tunnel there is an enlightened gentleman or a lady sitting who will tell us how to find multibaggers. But to take this conversation further, Atul, like you mentioned, this has been the best broad-based rally, at least over the last 27 years that I have seen the market, sector after sector, and mid cap and large cap, after mid cap and large cap have given us fabulous returns over the last 18 months. What have been your disappointments?
For me personally, I think that one of the big disappointments for me personally was that when COVID happened, I got a little nervy on the market. I felt that we all have playbooks, right? We all have experiences, and we've had. I've seen Harshad Mehta, I've seen 2000 IT, I've seen 2008, and all these things were pretty man-made. They were excesses, greeds that were there, and these greeds ultimately created excesses, and they went. And then I realized that these are cycles. These things are self-correcting. There will be pain, and then things will emerge. But what I saw in 2020 was actually COVID, and COVID was something which was not, I think, so man-made. But the fact was that we really never knew the end to it. It could. Today we forget about it, and it's just like a memory. But it could have been really, really bad. The kind of visuals that we had, where people were dying without oxygen, and hospital floors were filled with body, etc., etc. We all have been through, and that's a stage where I really thought that this is going to be much, much longer. However, what I felt, or what my learning was, that the markets have a way of surprising. And people ask, what is the next big crash, or what is the next big thing? The thing is that nobody knows. If someone knew, there would never be, you can never prepare for that black swan. There will be black swans. There will be black swans every few years. When they will come, in what name and shape, we don't know. After 2008 financial market crisis, we were waiting for the next financial market crisis. And what came was a very, very different thing. We had COVID. So for me, the big learning was that even though it may be a different black swan event, it was human tragedy, but somehow the markets still have a way out. And the kind of rally that happened very early, I got a little more defensive at that space. I had a lot of pharma, I had a lot of FMCG plays, and the market actually went on into a complete risk on mode. To think that when survival of human beings and survival of companies was a question, the market actually took on a different color. So for me, I think personally that is one, I would say, regret, or that is one big learning. Ultimately, market is the king. Don't fight the sea, don't fight the waves. Go with the wind, go with the flow, go with the trend. And probably that's why I'm a trend follower.
Wonderful. And one of the unmutable laws in markets and in life is that hindsight is always a perfect science. You live and learn, and that's how markets function. Atul, because you do long-term charts as well, and I need you to answer this one, is the trajectory of the Indian markets in the long term, let's say 5 to 7 years, especially on the Nifty, given 3 points which are tailwinds: a growing economy, an aspirational population which is now spending, and the financialization of assets that we are seeing. Sakshi stopped buying gold. She's into mutual funds. And I'm sure millions of women and men who are entering the world of job market are starting to invest really early. Given these very strong 3 tailwinds, where do you see the markets in the long term in India?
What happens is that over long periods of time, markets reflect the underlying growth in the economy. And if you look at the projections, like whether it's a 5 trillion, 10 trillion, whatever the time frame is, you draw these things, that ultimately is going to be kind of, reflected. Again, I don't have any formula, but I feel that I've noticed that markets give you 1.5 times of what the economy grows. So if the economy is grown at whatever, 6% or so, you are going to get 9%. And if you're talking about a 9% kind of growth that there is, I think the markets can give you 14, 15%. And I think that's phenomenal because, increasingly I am seeing that globally the options are reducing. the way economies are structured, the way the markets are structured, the number of options available are few. So the thing is that in India, if global opportunities reduce, it may be front loaded in the sense that India can actually see a gush of liquidity and our markets could actually discount things before we get to a 10 trillion economy. The markets could factor in the 10 trillion in the first 3 to 5 years. So I feel that ultimately markets are going to reflect what the economy is going to do. The question is it going to be front loaded or back loaded? I think in the case of India, it's going to be front loaded because India, I've noticed, has always been a country with a lot of promise. It has never been a cheap market. And as and when this shows some promise, money kind of gets in. And this time we are showing leapfrog. Forget about money getting in. Our domestic money started flowing. And this bull market is all about domestic money, domestic themes. And I tell you, like, for me, the litmus test is that when students go abroad to study, all kids are now going abroad to study. When most of them will line up not to get a US visa or to get a work permit, etc., etc., but they would want to come back. And I see that happening. And that I think is going to get reflected in the markets. So I see a healthy kind of, whatever, 14-15% hopeful returns, but I do get a sense that it will be front loaded. And that is why I feel that the coming few years are going to be years of great opportunity. And the biggest driver is going to be the flows that are going to come from domestic investors. I think it will be a tsunami. So I'm very optimistic of the short to medium term. However, in the long term, as long as we don't do anything foolish or shoot ourselves in the foot, I think
Yes.
things are good.
Things are good, and this is the Amrit Kal of Indian equities, as Mr. Suri so rightly puts in. Thank you so much for your time, Atul. It
Thanks,
was
guys. Thanks for having me.
such an educative 45 minutes which you spent on indices, on different asset classes, as also on a lot of bespoke indices that you make on your own. Thank you so much, and I hope that this wonderful journey that's unfolding in front of us will see you participating a lot more on Business Today television. And of course, ladies and gentlemen, if you want to get the best wardrobe made as far as males are concerned, Mr. Suri is the right man. I can tell you, I've been watching him for 20 years, and he's better dressed than Hrithik Roshan.
I would tend to disagree then. Hrithik Roshan comes with biases then. But many thanks, Mr. Atul Suri, for being with us. It's been an absolute pleasure to have you with us here on the show.
Thanks a lot. Thanks very much for having me. Bye-bye.
Okay, so that's it, ladies and gentlemen, on our weekly edition of Market Masters. You just listened and saw a wonderful conversation with Mr. Atul Suri. He sees a 10%, up to a 10% upside on the Nifty in the fairly medium term. And of course, things look really bright as far as the medium to long term aspects of Indian markets are concerned. Of course, there are pockets of overvaluation and pockets of under ownership. The key to successful portfolio building is identifying both and shifting from one to the other. Stick around with us, and we shall help you meet such fine gentlemen who have such a fabulous and strong grasp on the market. From Sakshi and my side and our team, thank you so much for watching. What a glorious day to be a part of this wonderful journey that's unfolding on Dalal Street. How do you rate sentiment after the successful completion of the G20 event?